Hello and welcome to this week's episode of How Money Really Works. As ever, I'm Peter, and this week I'm coming to you from the beautiful city of Macau, where the Chinese New Year celebrations are in full swing. We will be hearing from Stephen a little later on. He's actually in Tenerife on holiday with his family. This is going to be a much shorter and bit different episode. Now, some would say that is down to catastrophic technical failures. But since I'm the one that's in charge of the technical side of things, I'm going to say it's down to events and situations beyond any control because it's my show and I can call it whatever it is. When we do hear from Stephen, he's going to be running us through what's been going on in the world of AI and how that is driving the markets right now. He's also going to be looking at what's been going on with those markets in the West and also right here in Asia. He's also going to be looking at the new industrial revolution that's going on and why those of us that don't really understand AI, including myself right now in that, shouldn't allow ourselves to get left behind. Now, in the Chinese zodiac, this year is the year of the fire horse. Now, he's told us that he's got something lined up to do with a different kind of horse entirely, but I will be perfectly honest with you, listener and viewer, however you're consuming this week's show. I haven't been able to listen to his TED Talk, his sermon, or whatever you would like to call it. So before I hand over to our main man in personal finance, Mr. Hope, I want to wish you all, the viewers, the listeners of How Money Really Works, Gong Xi Fa Cai. That is the New Year's greeting here in China, and it literally means I hope you get rich. So what a better greeting to have for this show. So without further ado, here's Stephen.
Hi everyone, slight technical difficulties this week. Pete's over in China for New Year celebrations, and I'm away for half term here in sunny Tenerife. And as our old head of sixth form once said, there's a bit of a funk on the line, so this feels a bit stitched together. That's because it is. And if we ever get too professional, well, just tell us in the comments below. Right, before we properly get into things, as always, this is financial education, not personal financial advice. Your situation is going to be different to the next person, so always take advice that's specific to you. Investments can rise as well as fall, and you might get back less than you invest. You know the drill. Right, let's get into a shortened, nah, abbreviated Year of the Horse edition of How Money Really Works. Where to start? AI. Every time a new AI tool launches recently, it seems like markets have a wobble, and sometimes quite sharply. In the last few weeks, we've seen publishing companies fall, software firms, insurance brokers, even wealth managers, heaven forbid, have felt it. And the pattern is fairly predictable. A new tool is released, and immediately investors are asking, is this about to make an entire industry less profitable? And then within days, we see sharp corrections, double digits in some cases. So who knows what's happening? I don't think anybody really knows. Definitely not 6 months out, and certainly not 5 years out. AI is evolving far too quickly. But when markets don't have clarity, they price in uncertainty. And that movement, that's volatility. Now, volatility gets a bit of a bad rap. It's a measure of how prices fluctuate. So high volatility means sharper swings, but low volatility means a much steadier movement. And markets have always gone through periods like this. Political change, economic shocks, prices adjust. But the real danger isn't volatility itself, it's our behavior as investors. And that's where people kind of mess up. So when headlines are loud and prices are falling, our temptation is to step aside just until things calm down. But historically, some of the strongest recovery days have actually happened really close to the worst declines. So that means if you miss just a handful of the best days, your final outcome could look really different. And those best days don't really send you a text to warn you beforehand. And this is the bit that makes me pause for a second. And I often think the men in the 1840s who were ploughing a field by hand, they probably didn't realize that that steam horse in the field next one over meant that they were actually standing on the very beginning of the Industrial Revolution. And they look at this machine, but actually what they were witnessing was a complete shift in what human history was going to look like. So where does that leave us with I? Probably that same field, watching brand new engines starting up, which makes it feel uncomfortable and fast and definitely disruptive. But while we focus on the immediate noise, the world keeps spinning, and that rotation shows up in markets too. Now, some US technology names have dipped quite a bit recently, but Asian markets perform really strongly. the fastest, in fact, since the early 2000s when Pete and I were spending our weekends in Marlowe's and privilege. Japan's rising, South Korea's surging, of course, Taiwan's got the semiconductor chips. Nothing stays in one place forever. And if you've got everything invested into one theme or one region, then every shift's going to feel dramatic. Spread your risk sensibly, and the journey becomes a lot smoother. So hopefully that put things into perspective. Also, it's slightly surreal to realize it's 24 years since I asked Jeeves for an essay on the battleship Potemkin. Google is 27 years old and it's just issued a 100-year bond. So think about that. A company younger than some people watching is borrowing money that matures in a century. Markets aren't just short-term traders reacting to headlines, they're allocating capital for the long term, funding ideas that could be far in the future. So economically, the picture's a bit mixed. US jobs were stronger than expected in January. UK growth remains modest, but the FTSE recorded another record high last night. So a crisis, it's adjustment, and market to try and understand the change. And if you remember nothing else, AI will evolve, steam horses will become normal, new industries will emerge, old ones will adapt, but the principles won't change. Diversify, match your risk to your time horizon, and invest consistently. Now, if you avoid reacting emotionally to short-term noise and you keep your eyes on the horizon or the tides rather than the waves, that's how money really works.
Thanks for that, Stephen. I did see it. It was going to be a shorter show this week, and it really is, isn't it? I have to tell you, it's also the final show of season one. I know, I know. I'm sorry about that. But the reality is, I've got one book that has to be finished and another book that has to be started, and the publishers are chasing me around the world right now. So I've got to get that taken care of. We're working on a whole load of new content that will be coming up in season two that should be really, really exciting. Some incredible special guests that we're trying to lock down to come and help explain to you, the HMRW pod listeners, how money really works. So from me and Stephen and everybody involved in the show, a massive thank you for joining us through season one. We will be back in around a month or so. If you want to get in touch with us in that period, you can do that on our socials. The best way to get in touch with us is on Instagram. That's at HMRW Pod, or on TikTok at How Money Really Works Podcast. Thank you again for joining us. As I'm in Macau, I think I'm going to go and check out some of the casinos up they have here.